Welcome to the Explainer. Today, we're diving straight into a token sitting right at the absolute crossroads of traditional, bund-up finance and the wild emerging world of decentralized blockchain. I'm talking about Quant. This is just a truly fascinating asset to break down because its institutional promise here in May 2026 is absolutely massive, yet the actual market proof, well, that tells a much more complicated story. As we're going to see, having an impeccable narrative doesn't always automatically translate into a soaring price chart.
So picture this. What actually happens when a crypto project partners up with literal central banks, but nobody can actually verify its user base? That's the core tension we're tackling today. How does a project with Tier 1 global financial credibility simultaneously face extreme fear in the broader market? You've got major regulators on one side backing the tech, and then this highly cautious, totally opaque set of adoption metrics on the other. For anyone watching the enterprise blockchain space, this is the ultimate high-conviction, high-uncertainty setup. And honestly, the implications for the future of digital finance are huge.
All right, Section 1, Demystifying Quant and Overledger. Let's get right into it. To really grasp this, we have to define what Quant actually is. Listen, it's not just another standalone blockchain trying to steal retail users from Ethereum or Solana. Actually, scratch that. It's better to think of its core product, Overledger, as a massive universal translator. It's an operating system, or middleware, that allows ancient banking mainframes to securely talk to modern blockchains without needing a complete, risky system overhaul. Through standardized APIs, developers can build multi-chain applications, or maps, that seamlessly bridge the gap. They even recently rolled out Overledger Fusion, which is essentially an integration layer designed specifically for the heavily regulated corporate world to utilize multi-ledger rollup technology.
Now, why do institutions take Quant so seriously? Well, it all comes down to the engine running the whole shebang, the founding team. We're talking genuine, top-tier financial, government, and cybersecurity credentials. Why does this matter to us? Because in a market filled with anonymous founders and short-term meme trends, this team isn't just following the rules. They are literally the ones writing the international regulatory frameworks of tomorrow. CEO Gilbert Verdian wasn't just a chief information security officer at MasterCard's Vocalink. He originated the actual ISO TC307 blockchain standard. Add in academic and central banking heavyweights like Paulo Toscas from the Deutsche Bundesbank and Luke Riley co-chairing international standardization committees, and you've got a deeply entrenched powerhouse.
Moving right along to Section 2, Institutional Power and Scarcity. Let's look at how those killer resumes translate into real-world action. You know, the word partnership gets tossed around a lot in crypto, mostly as cheap marketing fluff. But these are definitely not marketing stunts. These are production-grade infrastructure integrations with major central banks and regulators. Quant was chosen as a pioneer partner for the European Central Bank's Digital Euro project, and they're delivering live infrastructure for the UK's tokenized sterling deposits project. When you see a single company participating in both the UK's Regulated Liability Network and the Bank for International Settlements Project Rosalind, it's pretty undeniable that Quant is deeply embedded in the workflows where true institutional adoption is actually happening.
Now think of token supply kind of like shares in a company. When you look at interoperability giants like Chainlink or Polydot, they have hundreds of millions, even billions of tokens, meaning current holders can be heavily diluted over time as more enter circulation. Quant, on the other hand, it is a completely different beast. It boasts extreme supply scarcity. Out of a maximum supply of roughly 14.6 million tokens, 14.54 million are already circulating out in the wild. That leaves a gap of just 70,000 non-circulating tokens. There are absolutely no massive treasury unlocks looming over investors here. So if enterprise demand for the network spikes, there is virtually no new supply to absorb that shock, making the QNT token incredibly sensitive to any influx of buying pressure. But, you know, every coin has two sides. Section 3, the bear case. Missing proof. Here's where the narrative does a bit of a 180, and we've got to impartially look at why investors are moving so cautiously. It's a massive paradox. On one side, you have this absolutely elite institutional promise, but it's totally weighed down by fundamental weaknesses, like a glaring lack of public, verifiable network effects. See, Quant operates with a closed-source architecture. Now, that makes total sense for banking security, sure, but it completely chokes out organic grassroots developer momentum. And more importantly, the token's value capture is highly indirect. Even if a massive Tier 1 bank pays millions to use Overledger software, it doesn't automatically mean they are buying millions of QNT tokens on the open market. And this is the massive roadblock for anyone trying to put a fair price tag on this thing.
I mean, for an infrastructure token hovering around a $1 billion valuation, we're basically flying blind. The market currently just has to trust that these private enterprise pilots are actually converting into sustainable QNT token demand. There's no transparent public dashboard to check active users, there's no authoritative transaction volume metric, and because Quant essentially operates like a traditional software-as-a-service company, charging private corporate licensing fees, their actual revenues remain strictly undisclosed. You are essentially investing in the promise of future optionality, rather than measurable current on-chain cash flow. So, how is this all shaking out in the wild? Section 4, May 2026, Market Realities. Right now, the Crypto Fear and Greed Index is sitting at a cool 25. That is extreme fear, folks. It shows that Quant is navigating a seriously risk-off macroeconomic environment. We're seeing things like hot US CPI and PPI inflation data sparking widespread panic, which always puts immense pressure on thinner mid-cap altcoins. When the broader market is fearful and capital is fleeing to safety, narrative-driven infrastructure tokens often take a severe hit, regardless of how strong their fundamentals or partnerships might look on a whiteboard. To put that fear into perspective, just look at this massive $326 million number. A recent 4.42% drop in QNT's price, it was actually triggered by this massive broader market wipeout of leveraged long positions. There were no hacks, no delistings, and absolutely zero bad news out of Quant headquarters. Instead, Quant was simply dragged down in the undertow of over-leveraged traders getting violently liquidated across the wider crypto space. It lost its breakout momentum entirely due to market contagion, serving as a pretty harsh reminder that even the most well-connected tokens are completely at the mercy of broader Bitcoin and macroeconomic trends. Because of all this turbulence, analysts are laser-focused on some key technical levels. And this is absolutely crucial to watch, especially since QNT moves with an incredibly heavy 0.85 correlation to Bitcoin's sideways chop. If Bitcoin drops below its support, we could see QNT pushed right down into that $64.77 invalidation zone. That's the critical price floor, where the bullish thesis starts to break down. But interestingly, it's also historically where smart money steps in to accumulate long positions. Conversely, for QNT to break through its main resistance at $71.73 and resume a true uptrend, it absolutely requires a healthy risk-on environment from Bitcoin, providing those necessary tailwinds. Let's tie this all together. Section 5, High Conviction, High Uncertainty. If we peek over at the derivatives market, it paints a perfect picture of where trader heads are at right now. There's a slight short bias, about 53% short to 47% long, beautifully illustrating a highly cautious trading environment. Open interest, which is the total number of active bets currently placed on the asset, has actually fallen by 18% over the last 30 days. This means the market is simply holding its breath. There isn't a massive leveraged crowd betting on an immediate breakout, but there's also no panicked crowd shorting it to zero either. Traders are literally just sitting on the sidelines waiting for definitive, verifiable proof that these massive enterprise partnerships are finally bearing financial fruit. So, if you take nothing else away from this explainer, remember this. Quant is not your run-of-the-mill, metrics-driven crypto compounder. It is a highly specific asymmetric bet on regulated enterprise infrastructure and tokenization becoming the absolute global financial standard. It's a high-risk, high-reward play for sure. If the world's central banks and massive legacy financial institutions actually shift their trillions of dollars over to blockchain rails for tokenized deposits and digital currencies, well, Quant is phenomenally positioned to be the exact middleware they use to do it. Which leaves us with the million or maybe billion-dollar question to chew on as we watch enterprise blockchain adoption unfold for the rest of 2026. The foundation is undeniable, the executive team is genuinely elite, and the token supply is incredibly scarce. But in a modern market that increasingly demands on-chain transparency, the ultimate test for Quant will be bridging that massive gap between a powerful private narrative and public, verifiable proof. Will those massive central bank partnerships finally convert into verifiable token demand, or will the missing proof keep this $1 billion giant sleeping? Thanks so much for joining me for this explainer. Keep a close eye on those technical levels, and I'll catch you next time.